This is the video lecture on common stock. Now, every corporation that sells stock, if they sell at least one type of stock, it would be common stock. And every time someone invests in our corporation, they're purchasing an ownership interest in that corporation. That ownership interest has with it many different rights. So the first thing we're going to talk about in this video lecture are the rights of a stockholder. And these rights are guaranteed to every person who owns our common stock. First of all, common stockholders have the right to vote. And that's very important because that's the way that they participate in the management of the company. Now, the importance of the stockholders' vote depends upon the amount of stock that they own. The more stock that they own, the more important their vote is. So, for example, if a person owns 10% of the company's stock, they have a very powerful vote, rather than a person who, say, for example, only owns a single share of stock. So the more stock that you own, the more influence you have and the more opportunity you have to participate in the management of the company. You also have the right to sell or trade the stock, and that's entirely up to the stockholder. And of course, stocks are actively traded on the market. You also have the preemptive right. Now, the preemptive right is very important, especially if you're trying to maintain your level of ownership. Say, for example, that you do own 10% of the stock in a particular company. If that company decides to sell additional stock, if you don't buy some of that additional stock, your percentage of ownership would actually decline. So that's why you would have to buy a proportionate share of that new stock in order to maintain your percentage of ownership. So the preemptive right means they have to give you, as a current stockholder, the first opportunity to purchase that stock. You also have the right to receive any dividend. So if the stock pays a dividend, you would receive that. And we're going to talk about dividends in more detail later on in this lecture. But the key thing here is if there's a dividend. The key word is if, because they do not necessarily always pay a dividend. And then you have the right to share in assets after liquidation. What that means is if the company does go out of business, and once they have paid their creditors, if there are any assets that are left, you would get your share. And it would be a proportionate share based upon your level of ownership. Now, to be honest, this final right is not particularly important because most of the time, if a company does go out of business, they're probably going to be in bankruptcy, and it's doubtful that they'll even have enough money to pay the creditors, let alone have assets left over. So many times that right, although technically you have that right, you're probably not going to necessarily benefit from that. Now, when we talk about common stock, there are actually different types of common stock, and we're going to see all these various types in our examples. The first thing that you sometimes see is called authorized stock. Now, authorized simply means that the company has gone to the board of directors and has received advance permission to sell certain numbers of shares of stock. So they have the authorization or permission, you might say, to issue that stock. Then there's going to be issued stock. Now that's the actual amount of stock that has been sold. So always remember that if you're working a problem and they give you a number for authorized stock and then a number for issued stock, we're always going to use the issued stock, because even though they may have permission, the issued stock are the actual number of shares that have been sold. So you always want to remember that. Then we have par value stock. Now, par value is like an assigned value, and typically we will see an initial assigned value on all common stock, and that's the par value. From time to time, you will also see no par stock, and that just simply means that they neglected to establish a par value. And then you have stated value stock. Stated value is very similar to par value. It simply means that it's a designated initial value. And we will see many examples of all these different types of stock. Now, since we're dealing with stock, we're actually dealing with corporations. And you'll recall, back in Accounting 111, we talked about all the different types of businesses. And we know that there are proprietorships, partnerships, and corporations. Well, it's only the corporations that actually sell stock. And in fact, from now on, in this accounting course, we're going to be dealing with corporations. And when you are accounting for a corporation, there will be certain things that will be a little bit different compared to the accounting that we did previously. And one of the things that is different is that corporations have different equity components. Now, you'll recall, we've always had an account called capital. And typically we had a capital account set up if it was a sole proprietorship or a partnership. But in a corporation, there are actually 3 different components. Now, one component will be the stock itself. But then we have a component called paid-in capital. Now, this represents additional money made on selling stock. So that's what our paid-in capital represents. And then we have a component called retained earnings. And that is simply money that has accumulated from the past. Net income and profits that we've made in the past. So those are 3 different components of equity. And in various situations, we will have to use some of these different equity components. Now, if we're going to have different equity components, it's very important for us to understand the behavior in terms of debits and credits. The good news is that all the equity components actually behave in the same manner. So whether or not you're dealing with stock or paid-in capital or retained earnings, they all actually behave in the same manner: debit negative and credit positive. So that means that if we want any of these components to be decreased, we will debit. If we want any of these components to be increased, then we would credit. So that is the pattern of behavior that you always see with these capital components. And remembering that is very helpful as we go through and work on our journal entries. Now, in terms of journal entries, the first thing we need to learn how to do is actually issue stock. So we're going to be issuing some common stock. Now, when this happens, there are actually different scenarios. There are about 6 or 7 different possibilities, and you never know which one of these possibilities is going to come up. So we need to have an example of each one. So we're going to go through each possible scenario in terms of issuing common stock. But the good news is that as different as these might be, there are always going to be certain similarities. And you'll notice those similarities as we go along. Now, this first example, this is a very common and very straightforward situation. This is a company that will be selling 1,000 shares of stock. It's common stock. It does have a designated par value that happens to be $10. And they're going to sell this for $10,000 cash. And we have to record a journal entry. Well, what's nice about this particular example is that this example is going to work out exactly the way we want it to. We're selling 1,000 shares. The par value is $10. Well, that's $10,000. And lo and behold, we're selling it for $10,000. So that means we're selling this common stock at par. So that is always the easiest and most straightforward type of transaction to record. So literally all we will have to do is debit cash $10,000. That shows where we have received the money. And then we will credit common stock for $10,000. And remember, this is a capital component. It's credit positive. So we're showing we have received $10,000 cash, and we now have in existence a value of $10,000 in our common stock. Now this next example is a little bit different. Some of the situation is similar, but some of it is a little different. This time a company is selling 1,000 shares. Again, it is $10 par value common stock, but this time they're selling it for $12,000 cash. So evidently, they were able to sell it for a little bit more than the par value. So when we do the journal entry, things are not going to work out quite so easy. First of all, when I debit cash, I'm going to have to debit cash for $12,000 because that's actually the amount of money that they're paying. But notice this, when I credit common stock, I'm still only crediting common stock for $10,000. Now why is that? Well, remember this rule. Every time I credit common stock, I have to use the par value. So no matter what the circumstances are, we always have to use par value on common stock. And if you remember that, that's going to be very helpful with all these journal entries. Now that creates a situation where things are not quite matching up. I received $12,000 for something that really was supposed to cost $10,000. So I need an extra $2,000. And I need that extra $2,000 on the credit side to make the journal entry balance. So that's going to go to my paid in capital. And remember, that is another one of those capital components. Remember, there were 3 of them. And I said that one, paid in capital, was for when we make extra money on the stock. And that's exactly what we just did. So really what happened was we sold these shares that have a $10 par for $12 a share. So that insinuates to me that the market price right now of this stock must be $12 a share. And remember, that market price, that's the price that it sells for on the open market. That price is always changing.